So Lula said to me, Felix, what are your top 8 stocks that no one's really heard of? What are your hidden gems? And I said, that's a great idea. Let's make a video out of that and you can help with the research. So this is what we've done. Now, you might have heard of 1 or 2 of these, but the other ones you probably have absolutely never heard of. And I'll explain to you why these are great businesses. I've also put together all of my research and the full benchmark at felixfriends.org/gems. You can download it. It's absolutely free. felixfriends.org/gems. So get your hands on my research, I should say. Tallulah's research. Shall we get cracking? Let's get cracking. Now, the first company we're looking at, you're like, I know this one, Felix. Adobe, this is not exactly a hidden gem. Okay, but I kind of couldn't leave this one out just because it's such a good business and we don't talk about it often enough. But the next ones, you'll be like, who? So give me a second. Now, Adobe has tremendous cash flow, tremendous growth, tremendous profit health. Is it super expensive? Well, actually, a D isn't the end of the world. There is an E and an F. So it's like, good companies are never really cheap, but let's just see how good this business really is. They have an 88% gross profit margin. 88%. That's insane. And it basically means no competitor is snapping at their heels. Otherwise, they wouldn't be able to charge the premium that they're charging. And Adobe is the company that basically came up with the subscription model. They invented it and they're very, very good at it. They're also very, very good at monetizing AI, which I love them for. Return on invested capital, which is really what I care about. How much money are you making on our capital is 28%. So on $100, they're making $28 profit every single year. That's like, right? And are their profits going up? Yeah, 15% a year. That's also staggeringly exciting. So exciting, I'm going to have to change to a green pen because most of these things are going to be wonderful. So a green pen seems a little more appropriate. And how much is this thing moving by? Well, it is up 74% on the year. So I'm not saying it's super cheap. It has come down a bit over the last month, but 5 percentage points. So that's something, a mini discount. And it's also, well, it's riskier than the S&P. It's just more techy. It's just moving more. But the return has also been like 3x the S&P in the last year. So I feel like the risk reward is pretty good. Now, of course, none of this is financial advice, just an old banker yabbering on about his thoughts and his research for the year. And there is a little bit of a warning here, which is it did drop 18% at one point in the last year. You know, which isn't for the faint-hearted. I'm not a roller coaster fan, but I actually like those opportunities because it just means there are opportunities when we can buy cheaper, and we'll run through some of those for some of the stocks coming up here. So that's Adobe done. That was quick, wasn't it? Pain-free. And now Brown and Brown. And you're like, Brown and who? Well, let me show you the numbers. So cash flow, amazing. Growth, amazing. Profit health, amazing. What's with the word amazing? It's overused, isn't it? Yes. Brilliant. It's my favorite word. Not super expensive, not super cheap either, but what do they actually do? Well, it's an insurance company. And you might think, but really? It's insurance? Really? Is that something we should get into? Well, I'll tell you a little bit more about it. First of all, they've performed like the market last year, down 2.6% on the month. And it's also somewhat volatile. It had a 14% drop last year, which means you have opportunities to buy this thing on a discount if you wait for the right moment. But the really staggeringly exciting stuff is this. They have a 49% gross profit margin, which is pretty decent for an insurer. Return on invested capital is almost 10%. That's pretty good still. I kind of like to be in the double digits, but we're splitting hairs. And profits have been going up at almost 12% a year. So they're clearly doing a pretty good job. Now, it's not a massive insurer, 4 billion revenue. It's a relatively small one. But look at how they've been growing. They are actually growing quite nicely. So a little bit of an outlier. I quite like it. What about the next one? Evolution. Evolution who? Indeed, you probably don't know this business. Great cash flow, great growth, amazing profit health, amazingly profitable. And what do? Well, gaming, basically gaming. So they provide and license live games and shows to casinos. And they do that in a lot of countries. Armenia, Belgium, Canada, Georgia, and so on, and the US. And they have a ton of games that they run, roulette, blackjack, baccarat, that sort of stuff you might know, but also Monopoly and Extreme Lightning Roulette. That sounds exciting. Football Studio Dice. If you really want to waste your life, you go into one of these gaming joints. But it's Swedish, and we like the Swedes. They are lovely people, and this is really why it's here. The gross profit margin is 100%. Now, the only time I ever see a number close to this is probably MasterCard. They have an insane gross profit margin. But yeah, they're just making money. So their delivery cost is obviously super, super low. Revenue has been exploding. And out of the 1.8 billion revenue, almost 1.1 billion is net profit. So this is just a money printer. Return on invested capital at 27%, and profits have been growing at 14%, which is kind of bonkers. So it's just a really, really good business. There are some risks with these things, regulatory and that kind of thing, always with gaming. But look at their numbers. Revenue going up year on year here, very, very consistently. Net profit increasing very, very nicely. And then what I love even more is free cash flow. Here I am. Going up, almost doubling in the space of 2 years to 1.1 billion. So their free cash flow is larger than their net profits. And that's just a sign of an extraordinary business. So they don't need to ever borrow money. They don't need any financing. Can do whatever the heck they want. And they're just printing money. So have a look at all the tickers, and everything else is on the benchmark links down below. And you can also see a summary of all the core numbers for these guys. Fortinet, we did talk about in a video not too long ago. Cash flow amazing. Growth is incredible. Profit health is out of this world. And their core numbers, again, are looking pretty good. Gross profit margin, 76%. I haven't got an ROIC number here. I'm not sure why. Data has dropped off the planet. But earnings growth at 18% is pretty staggering. And in my view, the whole cybersecurity risk thing is going to get way, way, way worse, because with AI, it'll be much, much easier to hack. It'll just be easier to hack. You won't need people. They'll just do it themselves, and the bots. And therefore, I think Fortinet is going to have a pretty good time. It did go up 25% last year, pretty much in line with the market. Most of that was in the December rally, really. Didn't have the greatest of years before that. Very, very volatile. Very, 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 very volatile. At 38% drawdown in the last 12 months. So watch out for big drops, and maybe then have a look at the core data and see if it's something you might want to buy on a beautiful big drop. Couple of risks is there is a lot of dilution with share-based compensation. I wanted to highlight that because it's a thing. And yeah, the industry is fast changing. So you have to kind of think, are these guys going to be the ones who be at the top? My feeling is that Palo Alto and Fortnite, possibly CrowdStrike, are going to be up there. I don't think Cisco is going to go anywhere either, but those are kind of the guys who dominate the sector. So, but, do your own digging as always. Now, here's one you've definitely never heard of. Unless you're Finnish, and I don't think there are that many Finnish viewers. Admicom. Admicom has incredible cash flow, marvelous growth, profit health out of this world. And look, it's a C. We rarely get a relative value of better than D when profit health is A. Normally it's an E or an F. So it's not that expensive, and that's probably because it's Finnish and no one's ever heard of it. Now, what do they do? It's sort of an ERP business for the construction industry. And it's pretty specific. But, you meet a lot of people who've made a lot of money, made billions of dollars, and you hang out in private airplane lounges and so on. And they say to you, I made all my money with, I don't know, the software for concrete trucks, something really obscure. So I like the obscurity of this. Essentially, it's project management and ERP services for construction. Now, 80% of their revenue, 80% of their revenue is recurring, which means it's a subscription business. And I love that. So people are very unlikely to cancel their subscriptions if there's something that they run all of their projects on. And they claim that it makes their customers 25% more productive. Actually, 90% of their revenues are recurring. I was wrong on that, 90%. So their customers obviously really like it, otherwise they wouldn't be sticking around. Now, there has been a bit of softening in the construction industry. These guys are mainly exposed to Europe, and we'll look at that in a second. But look at their gross profit margin. It's pretty good, 57%. Could be a little better for software, but revenue, and this is a tiny business, by the way, 36 million revenue, 27% return on capital, and long-term earnings growth isn't beautiful, and I think that's just because construction has slowed down of late, and therefore it might be an interesting opportunity to look at this. Let me show you the stock chart here. And it was trading at one point at 140, this is euros, but it's got an OTC listing, so you can trade it in the US. And right now it's back down to $44. So it's essentially trading at 2019 valuations, which is kind of interesting. It's come down all that much. But right now, it is actually, for the first time in literally years, peeked its head over the top of this yellow 50-day moving average line, which kind of means maybe we're actually breaking out of this. We're forming a baseline here, and therefore it might be worth to nibble a little bit on this. Obviously, always do your own research on financial advice, but I just thought it was a good numbers, good business, very loyal customer base, tiny, yes, but heavily beaten up. So I kind of like it for that. Now, next is Alimentation Couche-Tard. And what does that mean? It means you don't know what I'm talking about, do you? No, let me linger on for a little, just a second longer. Build up the suspense. Profit health is great. Price, well, the stock's gone up a lot. We actually don't like that. Growth is so-so. Cash flow health is very good, and it's not massively expensive. How do you know this brand? You all know this brand. This is Circle K. They also have a brand called Couche-Tard, Holiday, Ingo, Max, and so on. And they basically have these little convenience stores that sell tobacco and booze and candies and snacks and all the other stuff that kills people. And they also operate the Circle K brand in Cambodia, Egypt, Guam, Guatemala, Honduras, Indonesia, and so on. I could go on. Saudi Arabia, UAE, Vietnam. And it's been around since 1980. It's Canadian. Here are a couple of highlights. Lots of buybacks, which means they're making money. High return on capital invested. They are going to, well, they pay a dividend, if you like that sort of thing, strong earnings. And their earnings per share keep going up, which is what we really, really look for ultimately. And Circle K is a pretty big deal in that particular space. Now, something like a Circle K comes with a gross profit margin of, shudder, 17.8%, which isn't great, let's face it. But they do bring in 68 billion, so 17% of 68 billion is still quite a lot. So they're still making a 3 billion net profit. And on their capital invested, they make almost 15%, and their earnings, their profits are going up 12% a year. People are obviously trying to kill themselves faster on cigarettes and candy. So it's not your usual tech business, but I want to look at correlation. I want to look at how do we make our portfolio less volatile, and this is one of the sort of type of stocks that you might want to look at to balance out your portfolio, and I'll get to that in a moment, so remember this. Now, can we find the next chart? There's another one here, isn't there? Yes, there is. You will have heard of this one too, unless you live under a rock. LVMH, Louis Vuitton, Moet, and Hennessy, and well, it's an insanely profitable business. It's growing very nicely. Cash flow has been slowing down a little bit, but they just own luxury. And they've had a little bit of headwind of late. Chinese luxury spending coming down and all that sort of stuff a little. But there are some amazing things about this business. They have a Piotrowski score of 9. And Monsieur Piotrowski essentially says the stock is kind of perfect value if it's a 9. He didn't believe in the 10. He just thought 9 was the limit. I don't know why. But it's sort of kind of a perfect value stock from that point of view. And they have raised their dividends for 3 years in a row, consistently increasing earnings per share. And it's very, very, very profitable because if you shop at any LVMH brand, you are getting fleeced. And you're basically shopping because you're an insecure muppet and you feel that you need a branded item to make yourself more important. That's kind of it, isn't it? This isn't LVMH, is it? I hope not. Maybe it is. It's possible. Gross profit margin is 68%. That's like a software business, except that they make stuff out of dead animals. So it's kind of impressive in some level. Their net income is 18 billion on 92, so I don't need to tell you the margin. It's good. Return on invested capital is 17%, and they're growing at almost 9% a year, which is pretty staggering when you've been around this long. And they're just doing that through making brands better positioning, more products and acquisitions, and focusing on whatever makes them the highest freaking margin. That's really very, very good on that. And making people queue outside in the rain so that they're so desperate to get that bag when they get in the shop that they'll buy it at any price and in any color and in any shape. It's a glorious business model. I don't know. Don't know if I could pull it off, making my customers queue in the rain. I just think it's such a weird way to do it, but obviously people like it. Now, why have I got this chart up on here? Because there's one thing I quite like looking at, and that's for certain full of more established, slower moving businesses. It's the RSI, which is an indicator that tells you, is it overbought, is it oversold? Most people look at the top here and go, oh, it's overbought, therefore, I shouldn't be buying it right now. I kind of like it for indices and some of bigger stocks to look at it by drawing a line, the red line I've drawn here at the 50-point mark of the RSI. And it then creates an area below the 50-point line where the stock is arguably undervalued. We're right there, right here, right now. And if you look at the stock chart, it correlates with dips of the stock, and we're again in one of those dips. So it might be a good idea to look at an indicator like this and to say, well, I'm only going to buy if RSI is below 50, or there's other ways of doing it. You could say if it's below the 100-day moving average or the 30-week moving average or something. But I like the cleanliness of the RSI, that it's just less than 50. I'm buying. If not, I'm not. And yeah, it looks, it's been beaten up a bit, and therefore it isn't quite as insanely overpriced as it was, which it's come down 24 percentage points from its peak. So you're getting people queuing in the rain at a discount. Is this the last one? I'm not sure. I think it might be. OTC markets. Do you know what this is? Have you ever bought an over-the-counter stock, an OTC stock? It's these guys who are running it. So basically, if you're a company that wants to get listed on the New York Stock Exchange, but you don't quite tick all the boxes, or the compliance is too much for you, or you're a foreign company and you can't be bothered to do an ADR listing, which is tedious, then you go to these OTC chaps and say, can people please trade you my stock on your OTC stock exchange in a sort, and then they say yes, and they take your money for it. And they have amazing cash flow, fantastic growth health, and the profit health is out of this world. And here's a little bit about them. So there's a chap who is the CEO and also biggest shareholder. I think he's the biggest shareholder. Cromwell Coulson. That's a great name, isn't it? Cromwell. Who names their child Cromwell? I know what. I'll name my child Cromwell, the guy who stripped all the churches in the UK and, was a generally lovely man all around. Yeah, you obviously have high ambitions for your child. Well done, Coulson parents. And all of the management has been there absolutely forever. They basically own the OTC, over-the-counter space. They just own it. And the switching cost, which is essentially, if I'm a business that's listed on this OTCM market, if I want to switch to another company so people can trade me there, it's incredibly expensive and tedious with lawyers and regulation and all the people who are trading my stock, how they're going to shift it over. It's just a nightmare. So people basically don't do it. The same applies to the people who are trading or facilitating the trading, the broker dealers. Same thing applies. So they get a clear market leader in this space, and 80% of their revenues are recurring through subscription access fees from broker dealers and so on. So it's just a little world. It's a little bit like owning a very, very mini New York Stock Exchange, and their revenues aren't huge. 100 million a year, so it's a pretty small business, which funnily enough is traded on the OTC. Like, can you be bothered to list on the New York Stock Exchange? No. Why don't we make our own exchange and then we list ourselves on our own exchange? It's a brilliant idea, isn't it? Gross profit margin, 95%. See how I am excited? It's actually almost 96%. They are making a 30% margin, net income margin. Return on invested capital is an almost illegal 49%, and profits are growing 9% a year. So it's a well-run business, very well-run business. I would say high yields, dividends have been paid for the last 15 years, if you like. I like that kind of thing. And they probably do that because their core staff all own lots of shares, and that's how they dish out profits. More tax advantageous, possibly. And then here is, and I shall cover myself up a little bit. Don't worry, I'm not going to get naked. With a bit of a summary here of these stocks. And again, you can download this, links down below, felixfriends.org/gems. And just to highlight a couple of the wonderful things we've looked at here. 100% gross margin at Evolution, Adobe's 87% gross margin, OTC's 95% gross margin. I love looking at return on invested capital. I think it's just such a good indicator of whether it's a good business. And usually I look for a double-digit number. These all have that. Well, Brown & Brown at 9.9 is a fail. It's 10%. So they're all pretty impressive, especially OTC, and reasonable debt levels on all of these, and long-term earnings per share growth is generally pretty solid. So for most of them, 100% of the time, the earnings per shares are going up. For some of them, they have the occasional miss in a quarter, but overall, it's a fairly impressive pack to be hanging out with, which is, of course, why I made that list. Now, last but not least, glad you're still here, asset correlation. And I've added two stocks in here, Apple and Palantir, because a lot of people have those kind of things in their portfolio, tech. And I wanted to give you something that isn't very closely correlated to tech. And if you look at some of these, and I couldn't get the tickers for everything in here, like OTC and so on, but say Palantir and LVMH has a 0.01 correlation. None. Nobody cares whether you're buying bags if you're a Palantir shareholder or investor. It's just zero correlation. And that's kind of what we try to look for, is things that balance us out. Same with EVV here, Evolution, 0.23% against Apple. It's got a 0.15% against Adobe. So you're potentially introducing things in your portfolio that are going to make it smoother. And I like that. I like the broadening things out, so we don't always just talk about tech and the latest thing. Yeah, it's great, but there are also old random-ass businesses that are very, very profitable that are potentially worth getting into. Do your own research, of course, and make sure you download the felixfriends.org/gems data here. And where is Tallulah? Any final words? Hang on. What do you think? Tallulah, one bag of kitten. She says, why did you wake me up, you crazy person? No final words. Do your own research, build some wealth, make 2024 the year where you get kittens, street kittens if you're going to get them, and where your money starts working for you. That's what we're all about. Our mission is very simple. We want to make 1 million people financially free. I run regular live trading sessions, which you are super welcome to join. But the best place to start would be just to simply subscribe to the channel, and we'll get you there. Thanks for watching.